The financial world has been rocked by another tumultuous week, leaving many banks feeling the heat. The fall of Silicon Valley Bank, in particular, has sent shockwaves throughout the industry, causing significant damage to U.S. bank stocks. But why did this happen, and what does it mean for the broader financial sector? Buckle up, because in this inaugural video of our brand new series on market analysis and insights, we'll explore the causes behind the bank's collapse and uncover the far-reaching consequences for the financial industry as a whole. This is the Bullish Aristocrat. And in this channel I would like to share my investing journey, and give you all the tips and advice I wish I knew when I first started investing. So if you find that interesting, then please subscribe to the channel and like this video to help support us in reaching more people. Make sure to press the notification button to stay up to date with new videos that will be uploaded. The financial world was rocked last week when Silicon Valley Bank, the go-to bank for venture capitalists and startups in California, experienced a massive $42 billion bank run. This caused the second largest bank failure in U.S. history, resulting in widespread concern and panic throughout the financial industry. With deposits and assets of almost $200 billion at the end of 2022, Silicon Valley Bank was the 16th largest bank in the U.S., and the collapse of this financial giant has sent shockwaves through the entire sector. In addition to this, two other smaller banks that were vital for cryptocurrency-related ventures, Signature Bank and Silvergate Capital Corporation, also met their demise. So, what happened, and what are the broader implications of this disaster? Let's find out. In order to understand what happened, I want you to imagine a room filled with money. And the bank is the keeper of that room. But what happens when too many people try to take their money out of the room at once? That's called a run on the bank, and it's a nightmare scenario for financial institutions. In the case of the recent collapse of three banks, including Silicon Valley Bank, depositors withdrew more cash than the bank had in liquid assets, causing a domino effect of panicked withdrawals. This is the danger of fractional reserve banking, where banks invest deposited money to earn a profit. As long as everyone doesn't withdraw their money at once, it's a safe bet. But as soon as people start to worry and pull out their cash, it can quickly spiral out of control. However, the real reason behind the bank failures was a combination of factors that created the perfect storm. The tech and crypto industries had experienced a boom and bust cycle, leaving many investors scrambling to withdraw their funds. Meanwhile, interest rates had suddenly surged in 2022, putting pressure on banks to shore up their liquid assets. This perfect storm proved to be too much for Silicon Valley Bank and the two other institutions, which ultimately collapsed under the weight of their depositors' demands. In the years leading up to the bank run, venture capital firms had poured billions of dollars into startups, resulting in a massive influx of deposits at SVB. With deposits rising from around $50 billion in 2018 to almost $200 billion by the end of 2021, it was a ticking time bomb waiting to explode. Last year, two things happened. The U.S. central bank began raising rates at the fastest rate in history to combat inflation, and the tech industry faced a slowdown, both in terms of growth and new investment. This meant new deposits slowed down, and while companies were also withdrawing cash to fund operations. SVB had invested its assets in government bonds, which were considered safe but suffered significant unrealized losses when interest rates rose and bond prices fell. As clients began withdrawing more than they were depositing, SVB had to sell those bonds at a bad time, leading to further losses. When the bank failed to raise $2 billion to shore up its balance sheet, investors including Bill Ackman raised concerns, leading depositors to panic and withdraw their funds. On 10 March, California regulators took possession of the bank and appointed the Federal Deposit Insurance Corporation, FDIC, as receiver. 2 days later, regulators approved plans to use the Deposit Insurance Fund to make all depositors at SVB and Signature Bank whole. It's easy to see how the rapid rise in interest rates over the last 12 months led to SVB's losses. But the near-zero rates of the prior years also resulted in the massive increase in deposits that arguably set it up to fail. When rates are close to zero, the opportunity cost of investing in companies that will take years to become profitable is low. The result was what could probably be regarded as a bubble in technology investments. The recent bank failures and market turmoil have highlighted several key insights for investors. While the tech industry has survived, companies in need of funding may struggle. Bank stocks have been repriced to reflect increased risk, and some regional banks may still be at risk if they lose more deposits. The pace of rate hikes may slow down, but banks are likely to be more cautious, which could lead to tighter credit markets. While the financial system is not facing the same risks as in 2008, liquidity could still become an issue. As always, investors should remain vigilant and make informed decisions based on these insights. It's crucial for investors to always do their due diligence and research before making any investment decisions. This means taking the time to thoroughly research the companies, industries, and markets they are interested in, as well as keeping up to date on current events and economic trends. Remember that investing always comes with risks, and it's important to be fully informed before making any decisions. So take your time, do your homework, and make informed decisions to help maximize your chances of success in the market. Thank you so much for watching this video till the end. If you found it at all helpful, then please hit that like button and subscribe to the channel to always be up to date with new videos that will be posted weekly.